I would say the world's in a sort of a reasonable balance at the moment. Not too flash, but certainly not as bad as it was through the GFC. Similar story in Australia, but not quite as good. Australia has this problem. We had the biggest mining boom in our history. That's now come to an end. That's a drag on growth. So we've gone from a situation, I was just looking at the numbers just there while Russell was talking, because they released the latest unemployment stats 11:30, and I was looking at the detail there. WA, Western Australia, now has a higher unemployment rate than the national average of 6.4%, national average of 6.3%, and a higher unemployment rate than New South Wales. So the two-speed economy has gone in reverse. Go back a few years ago, it was the other way around. WA was booming. If I go to WA now, they're all feeling kind of depressed. The planes aren't as full anymore. It was the only city in Sydney where the Qantas Club was totally full of people with goatees and lying people. I recently heard on the radio that Qantas is actually cutting back on services to Perth, cutting a few services out that go to Melbourne, and smaller planes from Sydney to Perth. What is it doing? It's actually expanding capacity on the East Coast and increasing capacity internationally. Now this is very important. If you've heard the first half of that, you say this is terrible, it must be a bad sign. But they're putting their capacity, extra flights, extra seats, into where the demand is, and the demand has shifted. WA is struggling. That's affecting the national average in terms of economic growth. It's not growing at 8% anymore, it's growing at about 2 or something like that. But in the meantime, other parts of Australia have picked up to fill some of the gap, and that's very important to allow for that. So yes, the economy is not booming, not as good as it could be. The unemployment rate is 6.3%. Prior to GFC it was 4%. But it's not as bad as many people often claim it to be. Interest rates are probably going to stay low. It might even go lower again, because the economy can still do better. We're still going through this adjustment from the mining boom into a more broad-based economy in terms of the sources of growth. And to do that, we need low interest rates, we need a low Australian dollar. Aussie dollar probably heading into the 60s. Not the 1960s, but the US 60 cents levels. Why do I say that? When you've got a boom on and your commodity prices are going through the roof, your main exports, you're getting paid more and more for iron ore and coal and copper and all those things, makes sense, your currency goes up in value. But when you're getting paid less for those things, the iron ore price, 2011, we got $180 a tonne, US. Now it's about $55 a tonne. Massive collapse. So it makes sense that the Aussie dollar comes down when that happens. The Aussie dollar has fallen from $1.10 US, now only buys you about 73 US cents. So that's what's happened there, and I suspect that Aussie dollar will probably have to go lower into the 60s. Pretty low returns on offer from government bonds and term deposits. Shares. Now, I can't speak for all of you. I think that's, you need to have these sort of discussions with people like Russell. But from an overall perspective, in terms of the share market, I think it still looks reasonable to me. So as I say, I can't say have all your money in shares, it all depends on your personal circumstance, all those sorts of things. But do I think we're coming into a bear market in the market? I don't think so. Bear markets normally happen. There's a sustained falls in the value of shares. They normally happen from a point where shares are clearly overvalued, and I don't think we have that at the moment. They usually happen after periods of interest rate rises, concern about inflation. Those rises in interest rates create fears of a recession. And they also normally happen when everyone's feeling optimistic. You have euphoria. And I don't think we have that at the moment. So that's why I think, yes, we can have wobbles. This is, after all, August. The September quarter, if you go back through the historical stats, the September quarter is often one of the softest quarters of the year for shares. You may have heard of the old saying, sell in May, go away, come back on St Leger's Day. St Leger's Day is a UK horse race around September. But that is a pattern. It's been seen time and time again. that shares often do well over Christmas, into the new year, up to about May, then they have a rougher patch around the middle of the year, they bottom out, and then it's time to get back in. Now, should you trade on that? Should you be going to Russell each May and saying, I want out? I've had enough of shares, and we'll get back in. It's St. Ledger's Day, you might say no, because the year you try and do it, it probably won't work. But just bear in mind, we are going through that part of the year which is often a bit rougher. You know, this August, September, October period is often a bit rougher for markets. So could have volatility there, but the broad picture I think in share markets is okay. What are the risks to keep an eye on? Greece, that story is still not over. Like Russell, he's probably thinking, well, we're going to have a Brexit here, they're going to leave, they're going to leave the euro. It's a bit bright light there. They're going to leave the euro, and then suddenly it all pulls back again. Oh no, they're going to stay after all. I kind of think in some ways, well, maybe it'd be better if they just left. Let the stronger countries in Europe stay together rather than having these continuous upsets. But you can still have issues around Greece, because as Russell pointed out almost at the start of the presentation, they still have a lot of debt. And some would say they're never going to be able to pay all that debt down. So there's still issues around that need to be resolved longer term. So you still have potential for some blow-ups there. But just put that in perspective when it does happen. Greece is still very small. China, keep an eye on China, keep an eye on Australia post the mining boom, still issues there. And also one to keep an eye on is the Fed. Historically, when the Fed first raises interest rates, after a long period of cutting rates or low rates, it can cause volatility in markets. So I'll look at some of those points, not all of them. Just put things in perspective. That's what's happened in Australian and US shares over the last 15 years. If you go back 15 years ago, that was the tech boom. They zoomed up into the year 2000. Then we had the tech wreck in the US. Then a good recovery into 2007, particularly in Aussie shares. That's the mining boom period. Then we had the GFC. Good recovery in the US. Australian shares have lagged. Why have they lagged? Several reasons. One is America's had money printing. We haven't. They've had zero interest rates. We've had much higher interest rates. They've had the benefit until recently of a low US dollar, which has made their companies more competitive internationally. Whereas until recently, we had a high Australian dollar. And a very simple factor, we had a higher high. You look at that, we got all the way up there. The American share market did nothing for a decade. Just spun its wheels. The S&P 500 just spun its wheels, whereas we've gone to a much higher high. So it's always harder to get back to highs when they're a lot higher than in other countries like the US, where that high wasn't as high. And they're carried away with highs here, but anyway, I think you get the point. So that's enough on markets. I mentioned earlier, global growth, to me looks okay. A lot of detail on this chart, perhaps too much detail. I reckon I can improve the colours on that left-hand side, although AMP, I always blame the, whoever I come along with Adam here, I'll blame Adam. I like bright colours. The brighter the better, I think. Whereas AMP seems to have gone back to the first half of Pleasantville, that film from about 10 years ago, which is sort of black and white, and they sort of come out of that. So we're just coming out of the black and white phase of the colour world, and the left-hand side seems to reflect that. So there's so many damn colours there, but I can't tell one from the other. So I'll have to ignore that one. But on the right-hand side, what it shows, that reddy coloured line shows a measure of global business confidence. Obviously it collapsed at the time of the GFC, the red line. Then it rose. Then we had the Eurozone crisis, triggered by, you guessed it, Greece. Then a recovery, and we're sort of wallowing around a little bit. But the point about that chart there is that when you ask businesses, how do you feel? They say they feel okay, not booming, but certainly not busting. Which I think is a good thing. If it was booming, worries about inflation, higher interest rates. If it was going bust, you worry about profits collapsing. We're sort of in the middle there, which I think is a good place to be. And that tells me that global growth overall is okay. Now, why do we hear so much about the US? Well, one reason is it's still the world's biggest economy. And it's probably the world's most innovative economy, despite what we say. You know, we've all got these gadgets, which were, this one here, all the stuff in here was invented in Cupertino in California. And of course everyone else tries to copy it, but it's a whole bunch of reasons why we hear about the US a lot. But the reason we hear a bit about it at the moment is because their central bank, the Fed, run by a person called Janet Yellen, who's their chairperson, she is thinking about when she starts to raise US interest rates again. And she sees an economy where the level of jobs are going up and the unemployment rate's coming down. There's more confidence out there. Consumer confidence is up from the lows at the time of the GFC, and companies are investing again. So it's quite logical, isn't it? That she thinks, well, we can't leave rates at zero forever. At some point, we're going to have to raise them. And she's either going to do it. I don't have a strong view, I'll be honest here. It's either going to be September or December, probably one of those two. When she does it, it's going to be a very gradual process. Because, as I said before, inflation is still missing in action. Not a lot of inflation in America. Therefore, when she does start raising rates, it's going to be a gradual process. What about Europe? Now, I saw this cover on The Economist magazine. It's good when I have an audience. I'm a bit old. You have an audience who's young, no one guesses one. They don't know who Monty Python are, but that's the dead parrot from the Monty Python skit. And The Economist magazine is sort of implying that Angela Merkel, who's just there, is like the shop owner in that skit, saying, oh no, there's nothing wrong with Europe, it's only resting. And whereas it's, you know, the customer is saying it's dead, it's defunct, it's dead. And the shop owner is saying, no, it's a Norwegian rescue apparently. But in any case, that cover came out in October last year. If you bought European shares, when there was lots of scepticism about Europe at that time, if you bought European shares back in October last year, you would have earned a 20% return over these 6 months. So oftentimes when you see these covers in newspapers and magazines, sometimes the trick is to do the exact opposite. My favourite, must remember this one, back in August 1979, Business Week magazine in the US put out a cover story called The Death of Equities. You read that story, there's interviews in there with ordinary investors saying, I'm never going back into shares, I've had such a horrible run over the last decade. This is August 1979. And fair enough, the 70s were not good. My favourite TV show, The Brady Bunch, was canned, so I could no longer fantasise about Marsha. Before you get carried away, there's a Rolf Harris story. I was actually younger than Marsha, but she was playing a 14-year-old and I was 14 or so myself, so a bit different to Rolf Harris, so forget that one. And then I switch across the Partridge Family. It's canned as well. And I got to tell you, Mrs. Partridge was quite nice, Shirley Jones, along with Laurie. But then we had Whitlam, we had Nixon and Watergate, we had stagflation, we had the Vietnam War debacle. Terrible time for investors. But if you bought shares when Business Week put out that cover story, The Death of Equities, you would have done fantastically well for the next 20 years. So again, it's this old story, do the opposite to what some of the newspapers and magazine covers suggest. So Europe, I think, looks okay. European economic growth waxes and wanes, big recession there, that's the GFC, recovery, that's the Eurozone crisis, back to recession. At the moment, they seem to be motoring along at a reasonable pace. When I look at the economic data that's come out for the month of July, despite the Greek debacle, growth in Europe seems to be holding up okay. Now, what about Greece? Russell's touched on some of this, and there were some good graphs in there which are worth looking at. The only thing I would say there is that Greece looks to me like a special case. It's had similar problems in terms of debt, struggling with its budget deficit, lack of reforms, needing to reform their labour market and so on, that other countries in Europe have had, like Spain, Portugal, Ireland and so on. But Greece seems to have been the one that struggles the most with this. And I'm conscious of this survey where the Pew Research Centre asked Europeans their opinions on people in other parts of Europe. And the first column is amazing. People in Britain, France, Germany, Spain, Italy, who's the hardest working? They all say, you guessed it, Germany. Except these guys down the bottom here, the Greeks say they are. You've got to be joking. You've got to be joking. Like, as I said before, I'd never seen so many people sitting around that I saw in Greece. Hopefully there's no Greek people here, otherwise they'll make it. But it's funny when you transform the same people to Australia, they're hard-working, they're productive. There's something wrong in Greece. I don't know what went wrong over that 2,000-year period where they set off democracy to whatever they've turned into now. So it seems to me like Greece is a special case. Lots of other countries in Europe have got their act together. Very, very important. Therefore, I think if Greece does leave the Eurozone, it's unlikely these other countries will leave. And then some of you may be aware that Spain has an election later this year, and there's a mob there called Podemos, and they're a populist mob, a bit like Syriza in Greece. Now, if you're a Spanish citizen, would you vote for Podemos now, given what you saw happen in Greece? You probably wouldn't. So I'm just covering that one off if you are worried about populist parties in the rest of Europe. But I think Spain is a miracle. Spain is now one of the strongest growing countries in Europe. Its unit labour costs, its productivity has gone through the roof, its wage costs have come down. You're going to see businesses say, I'm going to set up a factory in Spain. So it's very important to distinguish Greece from the rest of Europe. What about China? Obviously China has slowed down. It couldn't grow at 10% plus forever. Because if you grow at that rate forever, you'll end up with massive imbalances. You go to Beijing. I've been lucky every time I've been to Beijing, including April this year, it's nice blue skies, like Canberra today. But every other day, when I'm not there, they tell me it's very polluted. So it's a bit like 17th century or 18th century London. So they've got problems with pollution, they've got problems with inequality, all sorts of issues. And they realise you can't grow at this rate forever. We've got to slow it down, have more sustainable growth compared to what was the case last decade. And so that's happened, but in the process it creates uncertainty. Investors don't know, well, how much is it going to slow down? Could it go even lower? Last year there was worries about their property market, and that's that red line through there is the monthly rate of growth in house prices, and you can see they were falling quite sharply through the middle of last year. If you look at the end there, they're actually now starting to rise again. And of course, more recently, the focus has gone to their share market. Now, the Chinese share market is, like many markets around the world, a very sort of eclectic beast. But there's parts of the Chinese share market that are very speculative, a bit like the NASDAQ in America, trading on price to earnings multiples of around 100 times. So you buy the share, and for every $100 you put in, you've only got about $1 of earnings. The broader market in China is made up of several large companies, and we tend to focus on them because our investments in China are via that, the top 300 stocks in China. There, the price to earnings multiple, the highest it got to was just over 20 times. And it's currently about 18 times, which is fairly similar to what you see in Australia. It's not way out of whack. The problem in China, this is their share market through here, the blue line. Don't worry about the numbers down there. You can see it took off about a year ago. It rose 140%, 140% gain in 12 months, to June the 12th. That's too fast. And of course, the authorities said, well, there's too much debt going in this market. We want to slow it down. It started to slow down. That slowdown turned into a tumble. The market fell about 30%. At which point the Chinese authorities said, well, okay, it's all right for America to have a 30 or 50% fall in their share market in a short period of time, but we are still a developing country. We can't afford stuff-ups here. And so they moved in and intervened to try and support the market, which I think was an understandable thing to do. So now you've got a situation where their share market is trading on a price to earnings multiple of around 18 times, which is actually around the level you see in the Australian share market. So from that point of view, we're not that worried about Chinese shares. In fact, about a month ago, when the market first had that fall, we allocated some more money to the Chinese share market. And we think that on a long-term basis, the Chinese story remains a very favourable one. So, we might just move on to interest rates. So I painted a picture there. Global economy continuing to recover, but maybe not as strongly as it has in the past, and there's not a lot of inflation around. So bottom line is interest rates will probably stay relatively low. So their interest rates in Japan, US and Europe, they're all around zero. Later this year the US might start to rise into September, December, but very gradual process. And in the meantime, Australia is up here at 2%. We might even see more interest rate cuts in Australia. I don't think that's necessarily over yet. I think we all know the story about Australia. I've already alluded to it quite a bit. We had a mining boom. That's come to an end. We now get much lower prices for iron ore. Went from $180 up the top here, now down around $55, the latest price. So we're almost given up all of the rally. in the iron ore price. It's almost back to where it was 15 years ago, not quite. That obviously affects things. It affects our budget. Government gets less tax revenue. There's a point there that Russell alluded to. We were at the top of a chart, and I feel kind of embarrassed being an Australian, thinking we've just been through the biggest boom in our history, and yet in the last few years our debt level has gone up there with the best of them. This is public debt. So I think a mistake has been made here. We did not put enough money aside during the good times. We should have been down there with Norwegians, who are at the very bottom of that chart from memory. And I think that's a very important point to make. I get very depressed when I think about our budget deficits year after year. The return to surplus keeps getting delayed. Now, fair enough, Australia has to spend money on those who are less fortunate, on education and so on, but I think we've still got to find ways to get that spending down. The funny thing is, in Australia, we had a massive revenue boost from the mining boom. That's now reversed. But our spending went up at the same time, and our spending is still way up at the top here. We need to get that under control. Either we've got to pay more taxes, which I wouldn't recommend, or we've got to cut government spending. Or there is a risk out there, one day, the rest of the world will look at Australia and say, you've got too much public debt, you're a problem, we don't trust you either. I think that's a fair way away, but I think we do have to get this issue under control. The reason I'm not a great fan of raising taxes, it's a very simple one. At the moment in Australia, just 17% of income earners, of workers, 17% of workers pay 63% of the revenue, the tax revenue the government in Canberra raises. So 70% of workers account for almost 2/3 of the income tax revenue raised by the Treasury in Canberra. So just think about that. If you raise taxes on them, some of them might say, well, I'm not going to stay in Australia anymore paying 49 cents, already paid 49 cents on the dollar. I'm going to nick off to Singapore where I pay 20 cents on the dollar. And I'll stay there for the rest of my working career, and I'll come back to Australia because Australia's a good place to retire. You don't want that sort of mentality to start creeping in. We've got to be very careful here. In New Zealand, the top marginal tax rate is just 33 cents on the dollar. Here it's 49 cents. So I think there is an issue there about the skew of tax being raised. But in any case, back on the mining boom, it's come to an end. That's led to lots of doom and gloom. A few weeks back, I have this thing at night time. I don't like watching TV all the time, so I have a little Apple TV device hooked up to my giant flat screen TV, and you can use that to access YouTube. And for some perverse reason, Apple took YouTube off. And I thought I'll Google it to find out the answer. And this is the trouble with social media and the internet these days. As soon as you try and find out the answer to one thing, you're distracted by all these other things. All these ads pop up. So you can't focus on a damn thing these days. I was just reading out to a colleague of mine on the way over here that someone was going to do Facebook in reverse. So, on Facebook you make friends by in a certain way. He was going to do it the other way around. He was going to walk down the street, and every person he sees, he's going to tell them what he had for dinner, how he's feeling at the moment, all that sort of show pictures of himself that were taken an hour ago, all that stuff you see on Facebook. Anyway, that's a bit of a distraction. I don't actually use Facebook that much, but it is, it's become very self-loving. There's pictures of yourself all over the place. But in any case, I'm Googling what the hell happened to YouTube on Apple, and up pops this little ad saying Australia Recession 2015, why it's coming, what to do, and how you can profit. And I'm immediately no longer thinking about YouTube. I'm back on the new economy. It says, click here to find out more. You click here, and they want some money from you. But then the funny thing is, I knew this scam because last year that same ad appeared and said, Australian Recession 2014. So it doesn't matter whether they get it right or not. All that matters is that you click here and they get their money. And that's often the way these things work. But there is a lot of negative talk around about the Australian economy. Very distracting, very negative. This doesn't help. Those two guys having a cigar after last year's budget, celebrating the welfare cuts, I guess, to Australians. Mr Abbott's week, and my local member, Bronnie, with, we call it helicopter gate or something. Chopper gate. I mean, what an embarrassment. It's his member too. And it's funny, those two are next to each other because he's the guy along, he's the Merengues next to us. It's a rather unfortunate situation. Now, I don't want to pick on them alone because the situation with Rudd and Gillard, Rudd wasn't too positive either. It's just that we haven't had sort of good governance. I think back, maybe it's back to my youth, think back fondly to Keating and Hawke, which I think was a good time in Australian politics. But then I'd also have to admit that Howard Costello was quite good in the great scheme of things. And we do need to see a return to those sorts of reforms, rather than this poll-driven nonsense that we get put up with these days, where the main issue is his wheat, their cigars, and her helicopter rides, which is rather unfortunate. But if you look at the Aussie economy, this is what's happened. Mining investment boom is now falling back to earth. So we've got to fill up the gap. We've got to fill up the gap. Housing picked up because of low interest rates. That's a good thing. Housing sector is doing its part for the economy. Retailing is looking a bit healthier. Confidence is still a bit subdued though. If you look at the overall picture, there are some reasons for optimism. Now, I don't want to be just Pollyanna here saying everything's fantastic. It's not totally fantastic, but there are some positives out there. Record low interest rates. If you do have a mortgage, you're actually doing quite well at the moment. And Australians owe the banks for your debt. I worked it out the other day, I've totally forgot the number now. It's about $1.7 trillion. The banks owe Australians for their bank deposits about $0.8 trillion. So it's about half. So in other words, when you cut interest rates, those out there in the mortgage belt get a huge saving, offsetting the loss of income to people like my mother with bank deposits. So that's sort of how it works. So low interest rates do actually help spending in the economy. You've got low Aussie dollar. People are coming back to our universities. Back to our universities. And you can see there that earnings from education, export earnings from education are now at record highs. Likewise, tourism, starting to earn money again. This is very, very positive. Parts of the economy that were in a hole are picking up. And I mentioned this earlier, New South Wales and Victoria looking more healthier. So what I've done here is look at growth in retail sales, building approvals to build new homes, home prices, employment, unemployment. And then I've ranked them all. Which two states are number one? Turned out they reckon number one, New South Wales and Victoria. Who's at the bottom now? WA. So in other words, I don't want to pour bad stuff on WA. I mean, it's just the way their economy works. But I just want to point out that as WA and the mining sector has gone down, other parts of Australia have picked up. This is very, very important. We had a joke in Sydney that the people of the western suburbs of Sydney were paying the price for the mining boom in Western Australia. How were they paying that price? They were paying it via higher mortgage rates, some of them losing their jobs because of the impact of the Aussie dollar. And if they had businesses, their mechanics, their truck drivers were saying, you pay me $200,000 or I'm going to work in the mines. That made life very, very tough. And I had friends who had businesses out there. One guy had a drum and golf franchise, 2 shops in the western suburbs of Sydney. One had to close. And he kept telling me, there's no boom in Australia, you've got to be bonkers. There's no boom. But now he's at least keeping on. His one shop is doing well again. So I think this is very important to recognise that yes, the mining boom is over, but other parts of Australia are coming back to life. Now quickly, I wanted to zip through some of the markets and then I'll hopefully have time for questions. What about share markets? I mentioned earlier. Now what do you look for when markets hit a top? When you're about to go into a bear market, you look for overvaluation. We look at a whole range of measures which tell us whether shares are expensive or cheap. And these measures are summarised here. It's a bit complicated, so I won't go into detail. But the good point is that most of these countries, Australia, Europe, US, and Japan, are in the bottom half of the chart. Their valuation indicators tell us they're cheap. And Europe is about the cheapest of the lot. So you can imagine in our funds, we've got a bit of a skew towards being overweight in Europe, European shares. But this chart looks at too much detail here, at the history of bull markets in Australian shares. So I've gone back through the post-war period. That is the period of bull markets through there. Like the last bull market ran from March 09 to April 2011. That was a relatively short one. The previous one went from March 2003 to November 2007, and then we had the GFC set in. So that's all the falls. The last big bear market was a decline of 55%, and this is the scale of the bull markets that you see afterwards, actually through that column through there. The worst bear market in history was back in the mid-70s. From January 1973, I'm a bit of an Elvis fan, have been since 1975 in fact. Elvis appeared via satellite. I remember watching this on NBN Channel 3 at about 5:30 I think it was, it could have been 7:30. 1973, January 1973, Elvis is via satellite. He's about as thin as I am here. This is 1973, this is the jumpsuit period. Elvis Aloha from Hawaii, you can get it on DVD or it's on YouTube or wherever you want to watch it. Fantastic show. Elvis, I think, probably at his best. After that, some people say he put on weight and eventually left the building. I'm still trying to work this out or not, but some say he did leave the building. Then, in 1974, the Brady Bunch was canned. Our market fell 59% because of those events. And a few others at that time. So that was our worst bear market, and the one we had a few years ago was the second worst. So far, our market is up 45% from the low 4 years ago. Historically, the average bull market in shares, that's a period of rising trend, is 126%. So we've underperformed a little bit. That tells me there's probably more upside ahead of us before this bull market totally ends. This chart, rather complicated, but just bear in mind, always when you buy shares, when you have investment shares, roughly half of the return comes from capital growth. The other half comes from dividends. And we in Australia often forget about the dividends, but the dividends are very, very important. I think they're coming back into fashion at last in the last few years. If you include the dividends on a total investment in Australian shares, and if you were unfortunate enough to put all of your money down at the high point in November 2007, you would actually now be ahead. Because capital recovery hasn't quite got you back to that high point. If you add in the dividends through that period, and Australian companies do pay good dividends, you would have gone to a new high. So always remember the dividends you're getting on shares. They are quite a big driver of the return you get. This is one of my favourite quotes on shares. It's by a guy called John Templeton, a US investor, died at the age of 95 a few years ago. And he once said, bull markets are born on pessimism, grow on scepticism, mature on optimism, and die of euphoria. So when you get a taxi and the captain is talking about shares, what should you do? Get out of it and get out of shares. Well, not what, but you get a bit fearful. If taxi drivers aren't talking about shares, then you can feel comfortable. And right now, I've got to tell you, I've had 3 taxis so far today, not one of them have talked about the share market. Which I think is a positive sign. We haven't got the euphoria, there's probably more upside to go. So, what about government bonds? They're pretty boring. Trouble with government bonds at the moment, the ones out of Canberra, they're only giving you a yield of about 2.5–3%. So you're not going to get a great return out of them. They are good to have in a portfolio, they're a good diversifier. When the world gets uncertain, shares for bonds often rally. So don't ignore them entirely, but don't expect great returns out of government bonds. Corporate bonds, probably a better bet. Housing, I'd probably favour on the property front, not residential property, because the yield is so low on residential property. In Sydney at the moment, the yield on a 3-bedroom house is about 2.6%. If you allow for the cost of maintaining the house, it's probably about 1%. So I'm not saying you can't do well out of property, you've just got to be a lot more careful these days. Commercial property, office, industrial, retail, certainly worth looking at because the yields there, this is the rental flow you get relative to the value of the property, they're much higher, much more attractive. And this one here is always good. Everyone says, well, Sydney's booming again. Sydney's booming again. Just bear in mind, about 10 years ago, Sydney property prices were falling. The rest of Australia was going up. So there's a bit of a catch-up there. But the other thing to note is if you take the average of property price growth in the other capital cities outside Sydney and Melbourne, it's actually quite weak. So Sydney and Melbourne are a bit of an aberration at the moment. So I wouldn't read too much into them. They're not indicative of the whole of Australia. And finally, on the Aussie dollar, the chart here goes back to 1900. The last 30 years, we've averaged around 75 cents. We go below it when commodity prices are weak. We went above it to $1.10 in 2011 when commodity prices are strong. Now we're probably on our way below that average. So what are we doing in our funds? This chart shows some of the indicators we look at. Valuations, whether markets are expensive or cheap, where we are in the cycle, what central banks are doing and so on. And you can see I'm getting more green signs, let's get rid of the wrong button, getting more green signals, in other words positive signals, for shares than I am for government bonds. So in our funds, we've still got a bit of a growth bias in our funds favouring shares. So that sort of shows up in that, which is too much numbers. I guess at the end of the day, you sort of think, well, it's all right for Shane Oliver, he just shows up here, gives his presentation, and that's it. Well, it isn't it. I actually do some other things, and one of the funds I'm very much associated with, is run by my team, it's called the Dynamic Markets Fund. And that fund we started up about 4 years ago, and it actually reflects our positions in various asset classes. And so all the research I presented to you today actually goes in to helping determine the asset mix for that fund. So we don't buy and sell individual shares, but we do have an exposure to the Australian share market via indexes. So it's a relatively low cost fund, but we do move our exposure around quite dramatically. And at the moment, you can see we have about 79% in growth assets. That's things like shares and real estate investment trusts and so on. And we have about 22% in 21% in defensive assets like cash and government bonds. So we have a bias towards growth in our portfolio, but you can also see within that Australian shares are okay. If you want good income, Australian shares give you a good income flow. But there's probably better growth opportunities overseas. So we've actually got more in for example, European shares at the moment. So the point about this fund is that when we get nervous about things, when our indicators are flashing red on things like shares, we take our exposure to shares down. Wrong button again. And we did that about 4 years ago when shares had a fall of about 22%. Prior to that, we chopped our growth weighting, our share weighting, quite dramatically. So it's quite an aggressive fund in that sense, but it's certainly worth thinking about. But I only put this up to demonstrate, what I'm saying here today does actually have some impact. We do have a favourable view of the world economy, financial conditions, and that's reflected in the positioning in our portfolio. So, summarising things, I think I've been through all of this stuff. I think the world's okay, very uneven recovery, but as I said, I don't want it to be booming. Because then you worry about inflation and high interest rates. Aussie dollar probably heading low. What does a lower Aussie dollar mean? For one thing, it means help for the Aussie economy at some point. It also means you might have more of your assets overseas. Because as the Aussie dollar goes down, the value of foreign currency goes up. So if you've got some money in the US, it's in US dollars, Aussie dollar goes down, the value of that US dollar goes up. So when you bring it back to Australia, it's worth more. So in this environment of a falling Australian dollar, it does pay off some of your assets overseas. What should we be doing as investors? And I say we because I mean me as well. I've always got to remember this stuff. Just remember, if you're a long-term investor, compound interest, very important. Steady, good returns over a long period of time will help you when it finally comes time to retire. And so my superannuation, I've been in the same fund, AMP Balanced Growth, since 1984 when I started work at AMP. It's provided, I think, a good return over a long period of time. I now also have some of my money invested in the Dynamic Markets Fund, that fund I referred to earlier. Always remember the cycle, things go up and down. Be nice to get that cycle perfect. We have indicators that try and do that. For many people, it's often very hard to time the cycle perfectly and often end up making it worse. But always remember there is that cycle there. Try and diversify, try and turn down the noise, try and avoid the crowd. The academy's are saying, pile into shares or whatever, maybe think a bit more cautiously, and also seek advice. Maybe you've done that, or you otherwise wouldn't be here today. You might think, well, Russell's paid me to say seek advice, but I actually have sought advice. Now, Russell's down here, I'm in Sydney, so I got a financial planner in Sydney. And the reason I did that was because I got to 41, I had one child, another one on the way, realised that I did not have a will, hardly understood a lot of the rules around superannuation. They're actually quite complex when you look into them. Trust structures, and so my financial planner has really helped me in a whole bunch of areas that I would have never thought of when I was in my 20s. When I started working at AMP, I don't need a planner. What the hell do I want one of there for? I'm an expert myself. And then I realised my expertise is slightly different to what a planner does for you, so that's why I say seek advice, just as when I want to get my plumbing fixed, I go to a plumber or electrician or whatever it is. Now I want to just focus on one little thing before we run out of time, and that's disruption. There's always change in the world, constant change. And this was a big one that happened over 100 years ago. It's a picture of New York City, Fifth Avenue, Easter Sunday, 1900. The question is, where is the car? It's all horses and horses and buggies. There is one car, it's just... better get used to these things. There is one car, and it's just there. Now, if you flip forward 13 years, just 13 years, to Easter Sunday 2013, where is the horse? That whole industry was wiped out almost overnight. In a relatively short blink of time, from 2000 to 2013, equivalent time frame, total revolution there. So what? Well, something might be happening at the moment. This chart here shows, kind of everyone like this one, it shows the cost of solar power in the US. $100 a kilowatt or a watt if you go back to into the 70s. So not a very good chart. It's by a guy called Tony Sema, and I thought I'd stick to the spirit of his charts. But that's the cost. It's collapsing. In 5 years' time, that's going to be down to 25 cents a kilowatt, a watt. So it's collapsed in price, and that's installed capacity in the US. So you've got solar getting cheaper and cheaper, and you're getting home batteries. I reckon within a decade, a big chunk of you guys will have batteries in your garage. So you'll go off to work, go off wherever you go. The power will be made on the roof overnight, go into your battery, and that will power your house for the night. And recharge your electric car. Because by then you'll have a Tesla or a Chevy Volt or whatever else electric. So the world is changing here rapidly, and at some point out there, self-driving cars will take over. They're already testing one in Adelaide. There's one in the US. Google's had one for a while now. They claim they've driven for miles and miles and miles around the US. There's only been 2 accidents, and they were when other cars crashed into the self-driving car. And what's that got to do with things? Well, it's good chance that people born in a few years' time will never own a car, because the cost of having one come to you will be so cheap. You won't bother with owning your own, because where is your own car at the moment? Sitting in a garage somewhere. It spends 95% of its life in a parking lot. So there is a huge disruption coming through on all of these sorts of things, and there's constant debate about coal and what have you, and do wind farms look nice or not. I think there's a massive disruption. These things are going to happen whether we like it or not. So I might leave it there. Happy to take any questions or insights. Everyone happy?
I'll ask a simple question to get things going. You mentioned that 17% of taxpayers pay the bulk of the tax, if I remember correctly. Who are these people? Where do they get the extra tax?
They're people with the top 2 income tax brackets. So it's people earning, the mouse now, there's the second highest bracket, I think, is 36%. And then the highest bracket, people pay 49%. So they're the higher income earners. And I guess the point was that our tax system is already top progressive. We're already taking a lot of money out of that side.
I apologise about that. You haven't had to fit in with the analysis by particular pencils, the concept pictures.
Yeah, I think you're talking about inequality.
Yeah.
Australia is old. It's one of the countries that haven't seen it. In America, the top earners are getting more and more of the income. That's not the case in Australia, because if you're studying a financial review about 3 weeks ago on page 6, I think it was, which used data from Builder. Builder's not a person, it's like a database, and it found that the Gini coefficient, have you heard of the Gini coefficient? The Gini coefficient is basically a measure of inequality in the country. Inequality in Australia since the year 2000 hasn't really changed. So the pre-tax earnings of higher income earners have gone up relative to lower income earners, but after you allow for the impact of the tax system and taking from here and giving to here, after tax income has not become more unequal. seems to be doing its job. The tax and welfare system in Australia seems to be doing its job, which I think is a good thing. I like living in a more egalitarian country like Australia is. But there is a danger you go too far the other way if you start removing tax rates or raising tax rates, then you can make it, you sort of push it too far. So you don't have an inequality problem, but your higher income and you say, I'm not going to work as much anymore. So it's a difficult balancing. I think Americans have got way too wrong the other way. They've become too unequal. It's too good for the rich, pretty tough for the poor, very tough for the poor. Here in America, with the poor there, we think poor and bad, America is a lot worse than we see in Australia. So yeah, still it's in right in relation to the US, but in Australia it hasn't applied, which is probably good. I think the French guy, capital in the 21st century is something going forward. It's not things. Piggity, yeah.
Shane, in the last 10 days, most of the major banks in Australia have announced significant changes to their lending policy in relation to invested property. For instance, your bank has announced that it's ceased lending for investment properties completely.
Yeah.
And that was only last week. What effect do you think this will have on the residential investment property market in Australia, and specifically on the markets that are not booming and the markets that are booming?
It's a good question because it's going to have negative effects. So the Reserve Bank, starting with something a year or so ago, got concerned that the low interest rates was leading to excessive price growth in some Australian capital cities, Sydney and Melbourne in particular, and they feared that a lot of that was being driven by investors. They didn't want to raise interest rates, which would be the normal solution because the rest of the economy still needed low interest rates. So they went to APRA, who regulates the banks, and back in December, APRA said that bank lending to property investors needs to be limited to no more than 10% growth. And it took a while, but progressively saw through this year more and more measures to try and slow that down. So the banks have tightened loan to valuation ratios, tightened up income tests to investors, and then of course 2 weeks ago they started raising interest rates. And one bank, AP, said we're going to stop lending to property investors for the next couple of months. If you look beneath the surface, I think it's because they're running above that 10% number, and so they want to get their property lending back down to within the 10%. Is one way to do it, is stop lending to them. But the upshot is that will have a negative impact. I think property price growth will slow down as investor demand is weakened, and the risk though is that you end up with unforeseen consequences, or consequences which probably aren't so good. So cities which have got very low price growth and price falls like Perth, they can be pushed down even lower. So that's a concern. The other one is that I'm conscious of this because when I bought my first house, I was not an owner-occupier. I was actually a trendsetter back then. I stayed in my family home with my parents for a long time, even though I was going in with my girlfriend. And we bought a property and we needed to live. So we were investors. So I was a first-time property investor. And those sorts of people like young Shane Oliver, are the ones who are going to get hit hard by this as well, because it's usually them who have the lower income levels and normally require smaller deposits and higher loan to valuation ratios. So I am a little bit concerned about the consequences of this. But then again, I think it's probably a better outcome than raising interest rates at this point in the economic cycle.
I've just got a question on, you mentioned that the government should perhaps make measures to reduce expenditure and increase revenue. One of the things that I was, and I think they did talk about maybe a hearing at one stage, but also changes to the superannuation tax regimes and perhaps due the accumulation of return phases. So I wonder if you have any insights into what they might do.
Well, the common suggestion seems to be along the lines that if you've got a certain balance, then you don't get concessions anymore. So you've got $2.5 million in superannuation balance, and maybe the concessions end. You're taxed at a normal rate. There's a lot of debate about this because it's actually a bit more complicated, I think. And you could also argue, well, certain people have behaved within the system, and they were told this is what will happen, and therefore those student aid or superannuation